In this video, we will talk about candlestick patterns that you should know as a forex trader. Without further ado, let's get started. Candlestick charts are the most efficient charts in forex trading because they show these four important prices: the opening price, the closing price, the highest price, and the lowest price for a selected time frame. When we talk about time frames, you should understand that when viewing charts, there are different time frames that you should choose from, such as 1 minute, 5 minutes, 30 minutes, 1 hour, 4 hours, 1 day, 1 week, and 1 month time frames. Let's look at a green candle with a 1-day time frame. From what you can see in this image, the instrument price at the beginning of the day was 1.0538. However, during the course of the day, the price fluctuated between a low of 1.0538 and a high of 1.0999 as seen from the week, but finally closed for the day at a price of 1.0722. If we change the time frame from a 1-day time frame to 1 week, the same will apply, but this time around, the opening price will be the price of the instrument at the beginning of the week, and the closing price will be its price at the end of the week. There are important candlestick patterns every beginner must remember, and the first in my list is Bullish Hammerhead. This Bullish Hammerhead will usually have a short body, a very long lower wick, and a short upper wick, or sometimes no upper wick. If you see it in a downward trend, it means the trend may be about to reverse into an upward trend. It simplifies trend reversal from bearish to bullish. This is because after the opening price, sellers tried to push the price down, which they did till it reaches the lowest price for the period, after which buyers push it back up, causing it to close at a price higher than the opening price. The buyers had the upper hand because not only did they overcome the sellers, but they did force the price to close higher than the opening price. How to trade the Bullish Hammerhead is to place your stop loss below the lowest intraday price, which is below the lower wick, and your entry price should be above the highest intraday price, which is above the upper wick. Next, Bearish Hammerhead. This bearish hammer usually have a long upper wick, a short body, and a short lower wick, or sometimes no lower wick at all. When you see it in an upward trend, it could mean a downward trend is about to start. It signifies trend reversal from bullish to bearish. The reason is because after the price opened at the top of the candle, the buyers tried to push it back, hence the long upper wick. However, the sellers stepped in and pushed the price down, forcing it to close lower than the opening price though the sellers had the upper hand. When you see a bearish hammerhead, you can choose to short sell the market by placing a sell order below the lower wick and placing your stop loss above the upper wick. Next is Doji. The Doji signifies indecision in the market. After the price opened, sellers and buyers tried to push the price up and down equally, and this caused the price to close almost at the same point it opened. After you spot a Doji, anything could happen. The price could start rising up or falling down. Next is the Bullish Engulfing Candlestick pattern. The Bullish Engulfing candle pattern consists of 2 candles, one small red and one big green side by side. The green candle completely engulfs the red one. The previous day, the bears were in charge, but the next day, the bulls took over completely, doubling the size of the red candle, and this signifies a downward trend may be about to reverse into an upward trend. To trade with pattern, place your buy order above the upper wick of the green candle and place your stop loss below the lower wick of the green candle. Next is Bearish Engulfing Candlestick pattern. The bearish engulfing candle consists of 2 candles, small green candles showing the bulls were in control the previous day, and followed by a big red candle showing the bears took control the next day and pushed the price down significantly. The bearish engulfing candlestick pattern, when seen in an upward trend, could signify a possible reversal to a downward trend. To trade the bearish engulfing pattern, place your entry price, which is your sell price, below the lower wick, meaning below the previous day's lowest intraday price, and place your stop loss above the upper wick, meaning above the previous day highest intraday price. Next is Morning Star Candlestick pattern. The Morning Star pattern consists of 3 candles, a red bearish candle, a Doji, which is red or green, and a bullish green candle. It signifies the trend is about to reverse from a downward trend into an upward trend. Next is Evening Star Candlestick pattern. This also has a 3 candlestick pattern. It consists of a green candle, a doji, and a red candle. It signifies a trend reversal from a bullish to bearish. The first day, the bulls were in control, then bears came in and started selling, leading to a doji. The second candle, where buying and selling pressure were equal. On the third day, the bears won, so you see a red candle where sellers have the upper hand and the price starts going down. Let's talk about market trend. Before you start a trade, you should determine if the market is in an upward trend or a downward trend. So let's start with an upward trend. An upward or bullish trend does not mean the market will not post low prices, but you will tend to see higher highs and higher lows. You will see more green candles than the red ones in an upward trend. This trend is always your friend, so most traders craft their market strategies around the prevailing market trend and not against it, except they're expecting the market trend to reverse. How to find an upward trend is by taking out your drawing tool and connecting higher highs, which is top of the green candles, to lower lows, which is the bottom of the red candles. So how about a downward trend? For a downward trend, you connect lower highs and lower lows. You can also use your drawing tools, as you can see here in purple ink. As we wrap up, remember this. While candlestick pattern can be powerful signals, they shouldn't be relied upon as a complete trading edge on their own. Think of these patterns as a possible triggers within a larger trading strategy. For instance, if you are trading around the London Open, a bullish engulfing pattern on a 5-minute chart might serve as an entry trigger, but it's just one piece of the puzzle. Every successful trading strategy is built on an edge, which comes from understanding the market dynamics of the specific instrument you are trading. Some traders may find edge in trading engulfing patterns on a weekly chart, but that edge only comes by careful study and backtesting. So keep exploring, keep testing, and always look out for what works for you in the market. With the right research and strategy, these patterns can enhance your trading strategy. But remember this, finding your unique edge is what makes the real difference. If you are seeking to join a forex trading community, you can join mytradingland.com. I will leave the link in the description below. We have a free economic calendar, forex trading session, and even university where you can learn about forex trading. Happy trading!